I'll also take the under on rate cuts. I don't even think we're going to get 3 this year. There's just no impetus for rate cuts. We've had 247 years as a republic. We've had 2 very short periods of time where they pushed interest rates to 0, right after the 1930s debacle with the Great Depression, and then again here after the global financial crisis. That's not normal. 4%, kind of where the 10-year is right now, is normal. America has the most to lose, right? And I just did a presentation on this, politics and populism. So, and I went through the history of empires, and it's really pretty amazing. They all rise for the same reason, power. They all stall for the same reason, politics. And then they fall for the same reason.
About 2 weeks ago, Fed Chair Jerome Powell told the House Financial Services Committee that January's higher-than-expected inflation data and jobs report did not change the Federal Reserve's expectations that cuts would be appropriate later this year. However, he noted that officials want more evidence that inflation is slowing before proceeding. "We want to see a little bit more data so that we can become confident," Powell said. "We're not looking for better inflation readings than we've had. We're just looking for more of them." Powell further noted that the U.S. economy was showing signs of strength, as was the labor market. "The recent strength of the economy and labor market means that we can approach rate cuts carefully and thoughtfully," the Fed chair added, emphasizing that there was no reason to think the economy was in or facing a significant near-term risk of recession. While the market took Powell's statement as a positive indication that rate cuts would be announced in June, Morgan Creek Capital's Mark Yusko believes doing such will be a huge mistake that could cause significant economic challenges for the United States. During a recent interview with Anthony Pompliano, Yusko gives his outlook on the U.S. economy in 2024 and beyond, talking in depth about rate cuts, inflation, and how technological advancements will change the global economy in no distant future. We will now bring you clips from the interview. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
I talk about this, the pollution of the most recent period, right? It's like all the data is polluted, right? The data on, price to earnings for the stock market, it's all too high. And people look, well, the last 10 years, I'm like, well, but the last 10 years have been above average of the last 100 years. So it's just the data is polluted. And the same thing's true here of rate cuts or interest rate levels, right? People seem to think that 0 was a normal interest rate. We've had 247 years as a republic. We've had 2 very short periods of time where they pushed interest rates to 0, right after the 1930s debacle with the Great Depression, and then again here after the global financial crisis. That's not normal. 4%, kind of where the 10-year is right now, is normal. So this idea that somehow we need to go back to 2% rates just doesn't make any sense to me. You asked a question that I didn't answer, right? Is inflation going to come roaring back like the 80s? I don't think so. I mean, we've all seen the chart, right? The big spike, the drop, and then the second spike in the 70s. Part of that spike was a false spike in the sense that they were double counting. Volcker's Fed was double counting interest rates, and that they were counting mortgages and interest rates. And there was this weird thing. And Mike Green has talked all about this in the past. So that was the big problem there. So I just don't see that happening. And all of this deflationary pressure that you talk about comes from technological evolution, and technology is not growing linear. Jameson Lopp put out the thing this morning that everybody, which is the Kurzweil chart, and it looks like this linear increase in technology and advancing in compute, but it's because it's on a log scale. And it's one of the things that drives me crazy all the time. Remember, shows these hockey stick charts. Well, any long-term chart has to be log scale. You can't look at a long-term chart and you see like the interest payments and they look all of a sudden like, well, that's because you're looking at 50 years. You need a log scale because going from 10 to 20 is worse than going from 20 to 30. So all of that says does Powell look at what's called hedonic price adjustments, meaning if technology runs faster, or like your washing machine gets your clothes whiter, that is deflationary in theory. I'm not quite sure why that is, but and okay, so my computer processes faster. I don't type any faster. I mean, I still type at the same rate. So I know that there's some productivity enhancement in having more compute, but for certain productivity, I don't really see it. But I do think on the job front, on your question on AI, as people get displaced, as human beings get displaced, that certainly will change the dynamic of inflationary pressures. My flip side, though, of that, my caution is everyone says at every new technological innovation, this can destroy jobs. It's true, right? I mean, machines took jobs away from people who were, plowing the fields or assembling things in factories. But here's the thing. We've destroyed millions and millions and millions of jobs through technology. But today, there are more jobs in the world than any time in human history. Right? That's just a fact. So we'll create new jobs, and that will reverse some of that deflationary pressure.
Yusko is not the only one who is wary of adulterated inflation data and how it is used to fool Americans. Last month, former U.S. Treasury Secretary Lawrence Summers released a co-authored paper that explores the effects of high interest rates on American consumers. The paper, titled "The Cost of Money is Part of the Cost of Living: New Evidence on the Consumer Sentiment Anomaly," explores an older and more accurate way of measuring inflation. Summers says the older system reveals the real amount of economic pain Americans have had to endure since 2022 as a result of rising prices. The system, which was discontinued in 1983, took into account personal interest rates and housing financial costs. When both metrics are added, the paper's authors argue that it offers a more worrying picture of inflation at the current moment than the official inflation numbers given by the Bureau of Labor Statistics. Giving more details on X, Summers wrote, "Pre-1983, mortgage costs were in the CPI, as were car payments pre-1998. Now, price indexes do not include borrowing costs. Thus, when interest rates jumped last year, official inflation did not fully capture the effects it would have on consumer well-being." He continued by adding, "We show that if we make an effort to reconstruct the CPI of Okun's era, which would have had inflation peak last year around 18%, we are able to explain 70% of the gap in consumer sentiment we saw last year." Summers further revealed that personal interest payments increased by over 50% in 2023. Yet, they are missing from the US government's data, an important point economists have noted for years. Let's get back to Yusko's interview as he speaks further about the economy and how getting on a Bitcoin standard can save the US and other economies.
So when do we become on a Bitcoin standard? I think it's actually a long time away. And the reason is, as much as I believe in Bitcoin being better money, I actually don't think anytime soon the nation states are going to abdicate their right to control their particular money, right? And look, I don't know if you've ever had Murray Stahl on the podcast. You should have him on. And he makes us look bearish. Like, how is that even possible, right? But he makes us look bearish, because I talk about this all the time. To me, Bitcoin displacing gold as the base layer of money, easy. $6 trillion market cap. That's like you can bank on that. That's totally easy. The next step, which is where the good money crowds out all the other money, and we start talking about, to your point, not Bitcoin in dollars or Bitcoin in yen or Bitcoin in euros, but euros in Bitcoin or dollars in Bitcoin, because it is the standard. There's a book called the Bitcoin Standard, right? But that's inverse to Gresham's law. Gresham's law says the opposite, that bad money always crowds out good, right? Gold is good money, but other paper money always crowds that out. People want to use the bad money because I don't even understand the exact reason for Gresham's law, but it's a law, right? And if you look at history, that's what happens: is people flock to the worst currency at the worst possible time, and that's why you get the hyperinflations eventually, Zimbabwe and Argentina and Turkey. So what Murray says is we're going to get a reverse Gresham's law, and this good money, this Bitcoin, is going to eat all global currency, which today is about 86, 87 trillion. Oh, just round it to 90 or round it to 100. Doesn't even really matter. Trillion here, trillion there. Pretty soon you're talking real money. That one's harder for me because I think we've seen how hard people are fighting just on the little stuff. As Bitcoin starts to siphon money out of the banks, right? We all experienced that with, we saw the lenders pop up and people took their fiat, converted it to stable coins or Bitcoin, and got paid interest in a zero interest rate world, which was unnatural. And the banks were like, 10 billion, who cares? 100 billion? Now we got a freaking problem. Now we're going to make it, illegal or unethical, or we're going to put people in jail. And there's still people in jail for writing code. It just boggles my mind. So I think it's a long-winded way of saying, I think they're going to fight it really hard for a long time. And the smartest people are going to get that, and they're going to increase their exposure. I mean, look, you and I have been talking about this for a long time. Get off zero, right? Zero has always been the wrong number. How big that number is in your portfolio, that's a debate.
Meanwhile, popular Bitcoin on-chain analyst Willy Woo says the leading cryptocurrency is just taking a brief pause, and we will get back on track in no time. In a recent post made on X, Woo revealed a Bitcoin signal that compares network flows into Bitcoin with price action. According to Woo, the signal likes capital inflows and dislikes risky price action, which increases volatility. His post reads, "This is a Bitcoin long time frame risk signal I've been working on. Scale in when risk is low and scale out when risk is high. It's saying, enjoy the dip while this consolidation lasts. This is not the top. It's simply an all-time high consolidation." In another post, Woo revealed we could get a double top for Bitcoin before the bull market ends. The tweet reads, "At the rate the Bitcoin macro index is pumping, I wouldn't be surprised if we get a top by mid-2024, which would hint at a double pump cycle like 2013. Then, a second top in 2025. Please share your thoughts on Mark Yusko's interview and Willy Woo's ultra-bullish predictions for Bitcoin in 2024 and 2025. If you like this video, then don't forget to give it a thumbs up, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.